I have some delightful video for you today. Congresswoman Katie Porter has really become very, very good at humiliating people who seem to think she's clueless, people who go in to testify before Congress and apparently think that they're going to be able to get one over on her when they are not, because she's not only extremely knowledgeable on all issues financial and business, but extraordinarily well prepared. And there was a subcommittee hearing yesterday called Modernizing Energy Development Laws for the Benefit of Taxpayers, Communities, and the Environment. It's a mouthful. One of the people who was testifying was Mark Murphy, the president of the Strata Production Company in Roswell, New Mexico. This is an oil and gas company. It's not a huge company. They have 16 employees and generate, according to a report, about $2.5 million in sales. So it's not a massive company, but not particularly relevant today. And in an exchange with Katie Porter, Murphy tries to claim there's no special tax rules for oil and gas. If we have expenses, we get to deduct expenses like any other business, trying to suggest there aren't special rules that apply to oil and gas that don't apply to a mom and pop hardware store or a taco stand or whatever the case may be. It's not true. And Katie Porter knew it, and she wasn't going to let it slip. Take a look.
They're estimated to be between 60 to 90% of the cost of drilling. How much of those intangible drilling costs do you get to deduct right away from your taxes?
We get to deduct all of those just like any other business. We do not.
How much do you get to deduct?
There seems to be a misconception out there that you're operating from, that somehow the oil and gas industry benefits from some special sort of tax structure. We don't. We actually.
Reclaiming my time, Mr. Murphy.
Other industries, right?
I will follow up with you, Mr. Murphy, but you do benefit from special rules. There's a special tax rule for intangible drilling costs that does not apply to other kinds of expenses that businesses have. You get to deduct 70% of your costs immediately, and other businesses have to amortize their expenses over their entire profit stream.
We also
so please don't patronize me by telling me that the oil and gas industry doesn't have any special tax provisions. Because if you would like that to be the rule, I would be happy to have Congress deliver. I yield back.
So it actually goes way beyond just this. The truth is that there are many tax benefits available for oil and gas investors that aren't available elsewhere in the tax code for other types of businesses. And some of them are sort of relatively not so much esoteric, but because they only apply to a very narrow scope of business, a lot of people aren't aware of them. The two largest subsidies for oil and gas are something called excess of percentage over cost depletion and the expensing of exploration and development costs. These add up to billions in subsidies for companies like Mark Murphy's. And when we talk about excess of percentage over cost depletion, what this allows producers, harvesters of oil and gas to do is deduct a fixed percentage of gross revenue as a capital expense each year, regardless of whether they actually had that capital expense or not. So when the way that you would typically deduct costs is you deduct real costs. You have, $1 million in revenue and $100,000 in costs, and you deduct the $100,000 in real costs. This special rule for oil and gas allows producers like Mark Murphy's company to deduct 15% of gross revenue for what's called resource depletion, regardless of whether they actually incurred that as an amount of cost. You just chop 15% right off the top. You made 10 million, you get to deduct 1.5 million, 15%, because you are depleting your source of oil and gas. You get a benefit from the very depletion of a resource which you are executing. What? That is a specific benefit for oil and gas. Intangible drilling costs, which include everything but actual drilling equipment. So when you do drilling, there's labor, there's chemicals, there's grease, there's all sorts of other stuff that are considered intangible. These expenses normally are 60 to 80% of the total cost of drilling a well, and they are 100% deductible in the year incurred. So if it costs $300,000 to drill a well, and we say, well, of that 300,000, 75% is intangible, the investor gets a deduction right away of the full amount, even if you don't produce oil, even if you don't strike oil. As long as you started to operate that facility by the 31st of March of the following year, you get to deduct all this stuff regardless of what's actually happening. Most businesses don't get to do that. Oil and gas also get accelerated depreciation of infrastructure. And they also get an exemption on alternative minimum tax. And I know we're getting sort of like wonky and deep here. There's something called alternative minimum tax. The point of alternative minimum tax is to avoid people from being able to deduct all the way down to owing nothing. So at higher incomes, imagine you make $5 million. You might be able to, by combining accelerated depreciation, intangible deductions, all this different stuff, you might be able to say, hey, you know what? I have an adjusted income of only $1 million. Even though there was a $5 million that came in, I've got all these different deductions, I get down to $1 million. The point of alternative minimum tax is to say you can't deduct yourself below a certain level of taxable income. The tax law specifically exempts those intangible drilling costs from alternative minimum tax. So regardless of your AMT, you can always continue to deduct out those intangible drilling costs. That's a gift to oil and gas. So nice job by Katie Porter pointing out that there are special exceptions made for oil and gas that don't apply to other businesses. And I could go on with even more of these. There are actually a ton of them. And the whole point, the oil and gas industry doesn't want you to know about these, because if you did, you might be outraged, as you should be.